Hey guys, welcome back to a new video. Today I want to show you what all the metrics mean in my stock evaluation um, platform, and I just want to do it on a stock like Apple, which most of us are familiar with and trust, and also investors like Warren Buffett love this stock and have also recently bought more shares. So let's look at all these metrics. This is, again, for beginners, a bit of a starting video or starting guide. Before I go into the deep evaluation of the 3M stock that is currently on a 52-week bottom and could be an interesting opportunity. So let's get into it. So let's see why all these investors love Apple. So as you can see, it is the biggest company on the market. It has a market cap of 2 trillion. Again, all these numbers are in millions, unless they're in percent, of course, or multiples like price to earning, but we're going to go over that in a second. So market cap basically means the total cost of the company, the total cost of all the shares that you can buy. So this is the cost per share, and this is the amount of shares are right here. So they have this many shares, and this is the price, and you will get the market cap. So next they have a revenue of 400 billion, sorry, and a net income of 100 billion. So let's see. So revenue is the total amount of money that basically circles around in the company. So if they sell something, if Apple sells a iPhone for $1,000, then that is their revenue, and their net income is basically the profit they make off that iPhone. The profit margin is how much percent of the revenue they make in their net income. So this number is also very important because it shows us if the company has great pricing power over the sector median. Because if a company has a bigger profit margin than the sector median, then it shows us that the company can raise prices in tough economic situations, like when there's high inflation, and it doesn't try to cut back costs or anything similar. It retains the same profit margin in tough economic times. Now, the free cash flow is also a very important metric. It is used in many of the valuations or discounted cash flow valuations that a lot of investors use because free cash flow is a very good metric. It basically measures all the cash that the company has gotten over the past year. So basically, the net income, for example, is the thing that the company gets. But if they pay debt or something, that is included here. And also, if they sell something or do an acquisition, it is also considered in the free cash flow. So next we have the two valuation metrics, the price to earning and the price to free cash flow. So you can see that these are relatively high on Apple. And the price to earning basically means in how many years will, if you buy the entire company, in how many years will you gain back what you invested into the company with the current net income? And the 5-year price to earnings is the 5-year average price to the 5-year average net income. So basically the same, but over a 5-year average. The earnings per share is how much money the company makes, net income wise, per share. So it's basically net income divided by the total amount of shares, and you get this number. The price to free cash flow is the same as price to earnings, but not for net income, but for free cash flow. So basically, in how many years you would make back your money if you bought the entire company, free cash flow wise. This is a very important metric. Unfortunately, it is not, you can not see it as the best thing for Apple because it's only $3 per share. And book value means if the company sold all its assets and paid all its liabilities, how much would it have per share? So it basically means if you bought the company and sold all its assets and paid off all its liabilities, you would get $30. And as you can see for Apple, it's only a very little amount of $3 per share compared to the price, which is very high. But of course, book value is not exactly the metric we should be looking for when we're looking at a $2 trillion company. We should be more we should be considering more the moat of the business and its future, because of course those are the positives of Apple. So next, the cash on hand and the debt. We like to see companies that have more cash on hand than debt. This is just the cash minus debt. So this means if the company paid all its debt and used the cash to pay all its debt, how much money would it still have, or how much debt would it still have? So in Apple's case, it would still have $71 billion dollars of debt left. So not great because they don't have a lot of cash, but their free cash flow is actually bigger than their cash. So that's very interesting. Next, we get the cash minus debt per share. So this basically shows you how much debt they have compared to the price. So in Apple's case, they have $4.43 of debt per share compared to 162, which is not that bad. Now the shares outstanding is how many shares they have, but we're going to take a look at that in a second. This is the total amount of assets and the total amount of liabilities. So assets can be anything from property to cash to basically anything that the company has. And liabilities can also be anything that the company has to pay, like debt or something that it owes to another company. And this is the assets minus liabilities. These are the metrics that are considered when calculating the book value. Now this is a very important metric. It is the 5-year return on invested capital. So in Apple's case, this is quite literally insane, because for every dollar that a company invests, that Apple invests, they get 49 cents back in 1 year, which means that they don't have to invest a lot of money to grow their profit, which means that they don't need a lot of money to grow their profit, and they can do other stuff like buy back shares and pay dividends. So now let's get over to the dividends category here, the dividends table. In Apple's case, it doesn't pay a huge dividend. Of course, this is nothing, but it's a very big company, and we need to remember that Apple focuses more on buybacks of shares, which we're going to see in a second. So their dividend yield is 0.5%, and their payout ratio is 14, or actually 15%. The payout ratio means, so if a company earns $100 million, let's just do it in millions, and pays out $10 million for the dividend, that means they have a payout ratio of 10%. So in Apple's case, they pay 14.95% of their net income towards dividends. So now we have a bunch of charts here. Let's start with the one in the center first. And this basically shows you what the market cap is, or what the total amount that the company is right now trading for is. So in Apple's case, it is 84% of the pie graph here, pie chart or whatever. The net income is really small. It's just 3.2% of the entire thing, and the revenue is 12.6%. So this basically shows you what the revenue is compared to the market cap and what the net income is compared to the market cap, and it basically shows you how much the company makes uh, compared to its market cap. Now let's look at this chart here. This one just basically establishes how the dividends are paid and the sustainability of the dividend. So the blue bar is how much worth dividends they paid in these years, and the green one is their free cash flow, and the yellow one is their payout ratio. It says it's the payout ratio, but it's the free cash flow payout ratio. And I actually did it. I actually made this graph to say the payout ratio of the cash flow, because I think that the cash flow is a way better metric than net income, because net income can consist of many things, and it's kind of hard to track like what kind of net income is, but free cash flow is just cash in, cash out, and it's much easier to see what they actually made when considering free cash flow as opposed to just considering net income. So now let's see the assets to liabilities chart. This one shows you how many assets they have compared to liabilities. This is also a important chart in my opinion, because it shows you the payout ratio, the ratio of assets to liabilities. And that's very important because you want to search for companies that ideally have a lot more assets than liabilities. And it shows you the growth of the assets and the growth of the liabilities. So in Apple's case, here they had a lot of assets and not that many liabilities, but you can see that the liabilities are going up and the assets are about the same. So that's not very good. But here you have a further breakdown of all of the assets and liabilities. And you can see that these are the total assets, right? All of this green stuff. And this is the total current assets. So you can see that they have a lot of receivables, which is okay, and they also have a lot of cash, which is great. It looks like they also have a lot of short-term investments, and you can see other current assets, other things. Now, Apple also has very little inventory, which is great because they don't have to have a lot of inventory to still sell those products. So that's amazing. Now, they don't have that much property, plant, and equipment, which is great because we want to see them ideally have a lot of current assets over long-term assets, because current assets are a lot more tangible, which means that they can be sold a lot easier, and you're not really going to sell property, plant, and equipment when there's a problem, whereas you could use your cash and cash equivalents and receivables. You can maybe even sell your inventory and get out of your investments to pay down something that you need to pay down, of course. So pretty great situation for Apple there. Now, Apple also has a lot of long-term debt. Not a lot of current debt, but a lot of long-term debt. So much, in fact, that they can't really pay it with their cash and cash equivalents, but that's okay because they do have a lot of free cash flow. But we're going to take a look at that in a different chart in a second. Now, the other long-term liabilities, we don't really know what those are, but we can only assume that that may be something that they can't sell as easily, but it's not categorized in long-term debt. Uh, they also have a lot of accounts payable, and of course, our favorite other current liabilities, which we don't really know what they are, but not too bad for Apple in liabilities. So scrolling down a bit, you can see that these are the shares outstanding. This is the amount of shares, and this chart is very important because it shows us if the amount of shares is declining or going up, which is controlled by the company, and it basically means that the company is buying back shares because the shares are going down. Now, why would a company buy back shares? Well, because it's very attractive towards investors. Because if you bought Apple in 2015 here, and the total amount of shares was, I don't know what it was, like 23,000, it looks like, and right now it's about 16,000, then as the shares went down, but you still have the same amount of shares. So your ownership, your percentual ownership in the company went up, which means that the net income compared to the ownership that you have is bigger. Now let's look at the debt to free cash flow to cash on hand for Apple here. You can see that they had a very big spike of cash on hand in 2019. Of course, cash on hand being the blue pillar, free cash flow being the green pillar, and debt being the yellow pillar. You can see that their cash flow is continuing to grow. It had a little bump here, but then it just growed, right? It has grown from then. Uh, but I don't like that their cash is going down, but their free cash flow is going up, and their debt has gone down in the last 2 years. Of course, it hasn't really gone down in the last 4 to 5 years, but I think that the the cash and free cash flow to debt situation for Apple is okay, since their free cash right now is really big. Um, okay, now this is also a very important chart, book value to price. For Apple, it's not that important because Apple is a really big company and doesn't really have that many assets and liabilities compared to the market cap. But you can see that for Apple, it's really bad, the situation with book value, as the price continues to grow and the book value continues to go down, which is not what we want to see. We ideally want to see the price go down and the book value go up, because that tells you that the company valuation is going up and that the price is going down, and you might be near a great investing opportunity. Now, for Apple, it's actually just completely straight up bad, because the book value right here is 3 and the price is 162, which is just terrible. Usually you want to see a ratio of price to book value for 2.5 on smaller companies, and for bigger companies it's like 5 is maybe still acceptable. But even according to Warren Buffett, who owns Apple, Warren Buffett says that book values is the most important numerical indicator that there is. Okay, so let's now take a look at these two graphs. These basically just show you the profit margin and the free cash flow margin. These basically tell you if the free cash flow margin is growing, if the company can afford to raise prices, and it also shows you the revenue compared to net income and compared to free cash flow. So, as you can see with Apple, it's just going up, and same with free cash flow. Of course, there was a little bump in 2015, as we already saw in the debt to free cash flow to cash on hand chart. Also, you can see that Apple's profit margin is very high and still going up, which also tells us that Apple can really raise their prices compared to the sector median, which is definitely lower. Uh, Now let's go over to the fundamentals. Now, this is still more of a experimental thing here, and it just shows you a snowflake of the company. a snowflake graph. I don't know how it's called really. I think it's called a radius chart. But this shows you in terms of growth, how good is the company? In terms of sustainability, how good is the company? Instead, in valuation, how good is the company? According to financial health, how good is the company? And according to dividends, how good is the financial company? And it basically ranks them on each of these on a scale of 0 to 5. And in the case of Apple here, you can see that they have excellent growth, excellent sustainability, very poor valuation, since you can see that the PE and the price of free cash flows are very high with Apple. The dividend is kind of a joke, and you can see that the financial health is also great with Apple because they don't have that much debt and they can pay it off relatively easily. So here you can list through different things. You can see that for growth they're really good, for sustainability they're really good, and you can see what the pillars are that you have set. So for example, 5-year shares outstanding growth is there, or should I say decline, because the shares outstanding should go down. But you can actually customize these pillars going down here. You can, if you want to, you can set your growth to be over 50%, I don't know, and then Apple does not meet the criterion, but I'm just going to leave them as they are for now, and you can customize all of these and look through them. So we have 5-year revenue growth over 20%, 5-year net income growth over 20%, 5-year profit margin growth over 0%, which basically shows us that the profit margin is not going down and that the company can afford to raise prices. And also same metrics with the free cash flow, the 5-year free cash flow growth and 5-year free cash flow margin growth. Now for the sustainability, we have 5-year shares outstanding growth, which should be below 0 because we don't want the shares to go up. The 5-year ROIC, which you can see that is very great with Apple, is 20%. The 5-year return on assets, which is over 10%, this is also a very important metric. The return on assets tells us that the company has a bunch of assets, right? It basically tells us how much they make percentage wise of their assets, considering net income. So if they have, let's take it in a very simple manner. Let's say that a lemonade stand has a cart for $100, and every year the lemonade stand makes $25. That means that the return on assets, this is yearly, but here is the 5-year average, but it's yearly. That means that the return on assets in this case is 25% because out of the $100 of assets, they made $25. So in Apple's case, it's 21.12%. Now the 5-year profit margin should be above 10% because we want ideally some space for the company to basically still make money, so that if the profit margin is like 2% and inflation is 10%, then the next year they're most likely going to be incapable of hiring their prices because of their profit margin that is so low at 2%. So we ideally want to see this above 10%. Now the 5-year book value growth, we want to see about above 25%. By the way, these are all per the 5 years. It's not yearly. That would be crazy. But we want to see growth. In the case of Apple, the book value is actually declining. Now these are valuation metrics. This is the price to earning metric. This is the 5-year price to earning, 5-year price to free cash flow, price to book value, and price to intrinsic value, which it will find from your watch list. So if you have anything in your watch list, and calculate the intrinsic value of 85, if I go to my big companies, you can see that Apple is the first one on my watch list. You can see that the intrinsic value of Apple is 126, and it basically searches if I have calculated any intrinsic value for any stock. And in the case of Apple, I have, so it's $126, and it basically checks if the price is smaller than the intrinsic value that I have calculated. Now, the financial health. This is the current amount of assets to current amount of liabilities ratio. We want to see this number above 1.2% because we basically want to know that the company has a lot more assets, current assets, than liabilities. Same with long-term liabilities. And next, we want to see that the debt divided by the 5-year average free cash flow. So this is basically in how many years worth of free cash flow will they pay their debt. And now we have cash and free cash flow minus debt. So this basically means if they can pay, this is like a higher level of this. This basically means that if they can pay their entire debt with their 1-year free cash flow and their cash on hand, then you will see that they still have $39,000 left, $39 billion left. Once they pay all their cash with their cash on hand and free cash flow. Now you can see the 5-year debt level change. We want to see this below zero because we don't want them. We don't want the company increasing their debt, right? In the case of Apple, it's not that bad. They only increased it by about 5% per 5 years, but still not the best, right? This is the dividend category here, and it considers if they have a notable dividend of about 2%, which Apple doesn't have, a high dividend of about 5%, which Apple doesn't have, and then we have the payout ratio, the net income payout ratio, which is below 60%, which Apple's is, and the free cash flow payout ratio, below 60%, which also Apple's is, right? And the 5-year dividend growth, you can see that we want to see the 5-year dividend growth above 25%, which Apple's is not. They did not increase their dividend a lot in the past 5 years. So that's that for Apple, and you can see that the summary of all these is that for growth they have 5 out of 5, for sustainability they have 4 out of 5, for valuation they have 0 out of 5, and for financial health they have 3 out of 5. For the dividend, finally, they have 2 out of 5. And then it also shows you here in the fundamental chart. But you should definitely not buy companies according to this, because these rates should be different for every company. Of course, the profit margin, for example, is great for Apple's at 23%, but the technology center has a lot higher profit margin than, for example, the medical sector, and maybe a 2% profit margin on the medical sector is not that bad because the medical sector really doesn't make that much money, and of course, people can't stop going to the doctor, so the medical sector can increase their prices according to inflation very well. So definitely, these are just generalized rates, and it shows you where you should pay more attention. So in the case of Apple, you can see that they basically have great metrics, except of the dividend, because they don't really pay a dividend, and their valuation, because Apple is basically always overvalued, because people really love Apple stock. Now let's move on to the chart. Now, first thing that I want to say is that this is a stacking chart, which means that it might look like the intrinsic value here is 100, but it's not, it's just 60. It does look a bit weird, but this is just the Google Docs format that is preset, and I don't really know how to change it because it just shows a weird line. Yeah, but I'll try to fix this. But to be honest, I kind of like the look of this graph, so we'll see. Now this shows you this is your calculated intrinsic value at 126. There, of course, will not be an intrinsic value if you don't calculate it, if it's not in your watch list, or maybe Europe, USA, and search stocks. Now, the intrinsic value goes up or down depending on free cash flow, because of course it's the discounted cash flow intrinsic value. So it basically automatically calculates that if the intrinsic value here is 126, then the intrinsic value would be 60 here, because the free cash flow is in that same ratio, right? Now the book value is not what you calculate. It's of course assets minus liabilities, which is downloaded from the internet automatically. So you can see that the book value of Apple here was $5, and now it's $3. So as you can see, it's going down, which we hate to see, but really the price has gone from 30 to 140, recently 160. So Apple, you can see that it's really overvalued, considering the book value that is really low, and also the intrinsic value that is also not that high, really. So as you can see, the theory about valuation has been proven right in the chart here. Now let's move on to the discounted cash flow finally, and how to calculate the intrinsic value. So here you have the free cash flow. It will automatically load this in for you, of course. On some stocks that are not from the US, it may not be exactly right, because every website has a little bit different free cash flow for non-US stocks. I don't know why. But if it isn't right, then you can just go up here and type, I don't know, maybe it loads in that it's 111 billion, but you can just write that, oh, it's actually 100 billion. Of course, it's in millions, but yeah. Don't worry about the other years. You don't have to fill those in. Fill those in. It's just the other years are basically just there to show you the average growth for the 10 years. But it should, of course, fill them in by itself, so it's not that bad to have them there, right? Then you need to enter what the growth is going to be for the next 2 years. So I think that Apple for the next 2 years is going to be about 8%. For the next 5 years, about 7%. And for the next 10 years, let's go with 5%, because I think that the growth of Apple is slowly going to slow down. You can see that in 4 years, Apple's income basically doubled, and it's basically like the hype. So we saw Apple go like this, and now it's going to slow down, and I think that right now we're somewhere here, and we're starting to slow down. So as you can see, I did 8, 7, and 5. Now, if you're wondering, I have them separated as 2-year, 5-year, and 10-year, because there could be like a crisis for the next 2 years, especially in the sector. So if the stock, people expect the stock to go down 20%, and by stock people I mean analysts, then you can do that and then still have the growth like this, which is way better than just having a singular number for 10 years. Now, the only other thing you need to do, this perpetual growth rate, basically everything that's in this blue color, you can enter by yourself, and everything that's in different colors, it basically loads in by itself, right? Perpetual growth rate, you should always basically keep this at 2.5%, because that's the general rate. This is basically a number which indicates that if you have would you rather take $100 today, or $100 and $2.5 in a year? And this basically says that it's kind of like the inflation, but it's also kind of like how much more money would you take in a year than today. It's a very complicated rate, you should basically keep it at 2.5%. And it's really like, I could make a video just about this one, so probably maybe even going to do that. But for now, just it's basically like the inflation. It's basically that, it basically means that the money in the future is worth 2.5% less than money today, because today you could invest that money and also buy something now, and also like inflation. So inflation is 2%, so the money will actually have 2.5% less value in a year. And it basically calculates the other metric called discount rate. It calculates it here, but it's not really accurate, because it only really shows you how much the equity is, how much it costs for the equity, and how much is the cost for the debt, and basically multiplies it by the total debt and total market cap. But it is not very reliable, because the discount rate is basically how much you want to make per year from Apple. So I'll do 9%. It's saying that it should be about 11%, but it's really not. Usually you want to keep this number from 8% to 12%. Maybe for extremely stable and unstable businesses from 7 to 13, but not really more or less than that. This basically says if the business is very stable, you should go with a lower number, and if it's not that stable, you should go with a higher number. Now, as you can see, we got the intrinsic value of approximately 131. Now, I have this at my watch list of 127, 126, which means that I must have just, I don't know, changed the discount rate from 9 to 10, or maybe I thought that it's going to grow 9% per year. I don't know, maybe, I don't know, maybe something else. But you should get about the same price. Right, and then you can add this to your watch list, anywhere from watch list to Europe, USA, and other things, right? And sorry, I don't know where I am. Okay, discounted cash flow, and it shows you that the intrinsic value of Apple is here, and you can put it in your watch list. And then it of course shows the intrinsic value in your chart. So say I wanted to change my Apple intrinsic value here, and say I wanted it to be 131, hit enter, and when we go to the chart, it's 131. Let me just change it real quick to 126, which is what I had there before, because I don't know, actually probably shouldn't have changed it, but it's what I calculated. But maybe I didn't see something that I saw before. Right now I'm just doing a quick little tutorial how to do this. Well, it's not really quick, but I mean, it's a tutorial. It's not really a quick video. But anyway, guys, so hope you understood all of the rates that are here. This was a very long video, but it's really okay if you didn't really understand everything, because we're going to go over this again and again in every video that we analyze a stock, and all you gotta do is just watch all the videos and you will understand what all of this is in a very quick manner, because value investing is not really that hard. Well, it is hard, but it's not really hard to understand. Of course, it is hard because of the emotional factor, and even Warren Buffett really said that you don't have to be smart to invest generally, because it doesn't really require a lot of intelligence. It just requires a lot of patience, and that's really it. But anyway, hope you enjoyed this little, actually I wanted to say quick video, but it's not really a quick video, so it was a very long video, but Anyway, I hope you enjoyed it, and I will see you next time.